Wealth isn't about what you earn today. It's about seeing where the world is going tomorrow and positioned yourself before everyone else. Sounds almost too good to be true. But millions of Americans use a Roth IRA precisely because of this powerful tax structure. So what exactly is a Roth IRA? Think of it as a special retirement account designed to hold investments while offering unique tax advantages. Here comes the first major rule. Roth IRA contributions generally don't give you an upfront federal tax deduction. And that sounds like a disadvantage. But here's where the story gets interesting. The potential benefit comes later, not today.
Inside the account, your contributions can be invested. Over time, those investments may grow, creating something far larger than your original deposits.
But remember, a Roth IRA itself isn't an investment. It's the container. What you invest inside it determines what happens next. This distinction matters because opening a Roth IRA doesn't automatically make your money grow. The account must actually contain investments. For 2026, the total annual contribution limit across your traditional and Roth IRAs is $7,500, subject to eligibility rules.
For eligible people age 50 and older, the 2026 limit rises to $8,600 because of the additional catch-up contribution.
However, not everyone can contribute the full amount. Roth IRA eligibility is affected by your income and tax filing status. For 2026, single and head of household taxpayers enter the Roth contribution phase-out range at $153,000 of modified adjusted gross income. At $168,000 or more, those taxpayers generally can't make a regular Roth IRA contribution for 2026. For married couples filing jointly, the 2026 phase-out begins at $242,000 and ends at $252,000 of modified adjusted gross income. For married couples filing jointly, the 2026 phase-out begins at $242,000 and ends at $200,000 of modified adjusted gross income. Now we reach the reason Roth IRAs attract so much attention. Qualified distributions can generally come out federal income tax-free. One common path to a qualified distribution is reaching age 59 and a half, provided the applicable 5-year requirement is satisfied. Certain other circumstances can qualify too, including disability, death, and specific first-time homebuyer rules subject to their requirements. For qualifying first-time homebuyer expenses, special Roth IRA rules can allow certain distributions, with a lifetime limit applying. And here's something many beginners don't realize. Roth IRA contributions and Roth IRA earnings don't always follow identical withdrawal rules.
Regular Roth contributions are generally treated differently from investment earnings when withdrawn, which makes record-keeping especially important.
The investment earnings are where the tax-free potential becomes especially powerful, but only when the withdrawal rules are properly satisfied. Consider the bigger picture. Money invested earlier has more years to potentially compound, although returns are never guaranteed. That's why the Roth IRA conversation isn't really about 1 year's contribution. It's about giving invested money decades to potentially grow. Now compare that with a traditional IRA. Traditional contributions may qualify for deductions, while withdrawals are generally taxable as income. The Roth approach flips the timing. Generally no deduction today, but qualified withdrawals can receive tax-free treatment later. So which is better? The honest answer is, it depends on your income, tax situation, goals, and expectations about the future. There's another major Roth advantage. Original owners generally don't have required minimum distributions during their lifetime. That flexibility can give retirees more control over when they take money, depending on their broader financial circumstances. A Roth IRA isn't a magical tax loophole, and it doesn't eliminate investment risk. Markets can rise, fall, and remain unpredictable. Investment expenses and account fees can also affect long-term results, so understanding what you're actually paying matters. And remember, the annual Roth contribution limit controls how much new money enters, not the future value your investments might eventually reach. So the Roth IRA strategy can be summarized simply: contribute eligible money, invest it, let time work, and follow the withdrawal rules. The real power isn't hidden inside the account name. It's the combination of tax treatment, investing, time, and disciplined behavior. For someone with decades ahead, the most valuable resource may not be a bigger paycheck. It may simply be more time. Imagine your future self, looking backward, wondering whether today's financial decisions gave tomorrow's version of you more choices. That's when retirement planning stops being about chasing a number and starts becoming a question of freedom, flexibility, and control.
But tax rules can change, personal circumstances differ, and eligibility matters. Always verify current IRS rules before making financial decisions.
If you remember only one thing, remember this: a Roth IRA isn't about getting rich overnight. It's about building options for tomorrow. Because wealth isn't just about how much money you make. It's about how intelligently you give your money time to work.